Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City. There are some obvious differences here that I have previously been at pains to point out compared to the Chicago contract. However, there were in recent days also quite a few similarities here with the Chicago contract. There was a bullish halfway hesitation in July, though a singular one during the pullback up, with an initial target in the 713 area and a secondary target in the 742 area. Both have been achieved, unlike the ones in Chicago. We also had the same monthly key reversal in July, and this is key, a similar uptime currently at 769 of the late March to early July shallow bullish shift pitchfork. This upper tine had kept the market back in August, much as the version we'd seen in Chicago, and caused a breakout lower out from a recent July-based bullish rising wedge pattern, with a target below in the 697 area. This was for the wedge pattern and was especially interesting because that's where we also have the 50% Fibonacci line, and a little below the 50% Fibonacci line for the whole absolute Fibonacci, and a little below the 50% Fibonacci line for the old 2011-2019 move at 692. Now prices overshot this support and went down as far as breaching the odd combination of the rising short medium moving average, currently 712, and the lower time of the bullish Andrews pitchfork, currently at 713. And the middle time of the bullish shift push pitchfork, also at currently 682. If that wasn't enough, just below was at that time the slowly rising medium moving average, currently 673. What that ended up meaning was the market was halted and turned back up 3 weeks ago. Now, in the process of moving up, the market created a small reverse head and shoulders formation over late August, late September period. Now, market broke up through the neckline last Thursday and exploited the move up last Friday. Thus, we have an initial target X not too far overhead in the 776 area, and a secondary target X1 in the 793 area. Now normally I would add here that a secondary target is usually hard to get. However, even though we are close, the initial target X in the 776 area is seemingly also hard to get. You see at that, the high on Friday is the upper tine previously mentioned, currently 769, as well as the high back in August at 769. Now both of those as well. I'd now add one more thing to the mix, the newly drawn early July, early September bullish shift pitchfork. You see the middle time for this currently runs through 770. This adds further to the capping pressure, but in a limited way. It all now depends if we see a move higher over the cap on the current market and towards target X and target X1. If we do see such a move, then the bullish tines are running the market higher. If not, then the old upper tine, and to a much lesser degree the new middle tine, are running the show. Whichever it is, has some time, maybe until the end of October, to make up its mind. Just be aware of false breaks. Finally, all this is in the shadow of July's monthly key reversal up. Minneapolis wheat. I have to say it again here. I continue to admire this contract, really admire this contract, and with some unabated passion, as it has been and still is a series of brilliant pieces of technical action. I have repeated this same mantra now, well, for months. Yet there are a number of, let's be honest, quite a few huge differences here in this contract compared to the one in Chicago, and also the Kansas City contract. For starters, and perhaps supremely important, the August-December 2020 bullish Andrews picture, which has run this market, well, for a while now, and it tends to be now a little bit more closer, was and is still valid. But you would have to allow for some aberrations over the summertime. The key feature over the summer had been how the market had punched up and down over and under the fantastic upper tine, currently 981 of the bullish Andrews pitchfork. During that time, prices still moved higher, and when it looked like they might fail, well, those were the very same actions also allowed me to draw a more acute April to May bullish Andrews pitchfork. This second one had grown like a branch out of the first one. 7 weeks ago we found the lower tine of this new Andrews pitchfork crossing up over the upper tine of the old Andrews. And there's the rub. Because of this conflict, we stopped the market's rise for the second time, and prices then pitched lower after. Thus the newer, bullish and more acute Andrews pitchfork is no longer viable, and I would normally retire it, but it looks so good at showing the deviation and the failure of the deviation that I think I will keep it there just where it is now because I like it. So where are we now? Well, the curling lower of prices had seen markets start to accelerate their drop down through the rising short medium moving average, currently 8.99, and below the middle tiny original bullish Andrews pitchfork, currently 9.08. However, both these two supports eroded the bearish incentive and re-established the bullish incentive, such that Friday saw the third highest close in recent times. Hence I would keep an eye on that combination of the rising middle tine and a flat line into rising short medium moving average. Any serious deviation from there could be an indicator of the next move, obviously assuming here's not a false break. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.